On to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, Cyprian, what's going on?
Happy February 18th. And as we were just kind of talking,
Options expiration.
that's today, right?
Today's options expiration.
Yes. So we'll have some good setups to maybe look forward to.
Uh-huh.
And anything else that you have on your mind.
Yeah. Well, I mean, of course, where's everybody focused? They're focused on Russia and Ukraine, right? They're focused on what's the Fed going to do in a couple weeks in March for controlling inflation. Is inflation even a problem? And what about COVID, right? So COVID seems to be something in the past. All kinds of governments are getting rid of mandates and things like that. Does that mean that the economy is going to start leveling out? These are some thoughts that I and a lot of people have on their mind, right?
Yeah, and this week's kind of all this information being put into the market and the market kind of not necessarily knowing what to do from it. I feel like this week's big news was the Russia, right? Everyone kept looking at the troops and they were getting close and then they were moving and that effect was having some sort of reaction, but nothing like it's Friday and nothing really has changed.
Yeah, the scoop of the matter is it's uncertainty. We're always talking about confusion, uncertainty in the markets. And so one of the things you can take a look at, I'm going to share my screen here, and one of the things we can take a look at, first of all, I've got up on my screen right now the economic calendar, and it was like a nothing burger today or this week. So we had what's called producers price index. Producers price index tells us about wholesale inflation versus retail inflation. So retail inflation is what us consumers see on the price tags at the grocery store and at the gas pumps. Producers price index is what we see when businesses are doing businesses. So the supply chain, like when the manufacturer sells to the distributor, and that's where you see that. But that didn't really affect the markets, right? We also had our retail sales report and our industrial production report. All of these are running hot, by the way. But again, didn't really see the market digest that too big. And even today, we had our home sales report, existing home sales. That's running a little bit hot. Still, no effect by the market. The market is focused on these headlines around the Ukraine and Russia, and also trying to speculate about what's going to be happening moving forward. Now, take a look over here. So this is our S&P 500 chart, and we've been watching this. If I go back a little bit, S&P 500 was on this huge uptrend. By the way, I gotta plug myself for a second, Sip. On Tuesday, in our premium selling program, for anybody who's interested, we're doing a once a month lecture, and it's this Tuesday coming up. And we're going to be giving our folks an exacting method in order to identify when the big trends change. So if that's something you're interested, you might want to, jump into our program, because this Tuesday we're going to be going over a actual data-driven method to know the exact date and time that one of these big trends changes direction. So we've been talking about the S&P 500 having changed directions. It was on an uptrend for almost 2 years. And as of this date right here, January 3rd, we know that it's now on a downtrend. Our question has always been, what is it going to be with respect to this line at 4,300? But I want to go ahead and overlay our VIX volatility index. Or actually, let's just take a look at the VIX. So the VIX is a implied volatility measurement. And, when the world is in kind of a steady state, we can expect the VIX to be somewhere between 10 and 20%. If you take a look right now, the VIX is hovering very much above. It's at 35% roughly right now. that happens when there's a lot of uncertainty. In fact, the VIX is driven by option prices, right? It's a little bit more complicated than that, but the buying pressures that people are putting on options right now pushes the VIX volatility index up in price. What does that mean? People are buying options. When do people buy options? They buy options when they're afraid, when there's uncertainty, when there's confusion in the markets, because options are a form of hedge or protection. And so that's what we're seeing right now. Now, as option traders, what does that mean? Well, number one, we know that money is not created or destroyed in the markets, it simply changes hands. And so, what that means is if people are buying options and they're driving the price of options up, you should be on the selling side in order to take advantage of this buying frenzy, right? And so, that's something to think about.
All right, so we're in this little lull. It does look like there's an uptick in volatility, and I guess what's the next big news item? I guess that we're going to be looking at. That might help dictate whether we'll hit that. What was it, 4,300?
Yeah,
I'm
4,300.
I'm
That's down
assuming
here
it's going to
this
be one of these interest rate decisions.
It really could be. So we've been talking about this heavy level of support at 4,300. Remember, we like to look at the S&P 500. I know that the talking heads on TV are always telling you about the Dow and the Nasdaq. To me, the Dow is like royalty, right? The Dow is like the king and queen, but the S&P 500 is the prime minister. That's the one that really represents our watch lists and what's going on. So we pay attention to the S&P 500. So we've been following this heavy level of support at $4,300. And we know that we're in this downtrend where every time we get a move down, we are in range expansion. We basically retrace more than 100% from the last move. Whenever we're pulling away from this, we're less than 100% of the last move. So we know we're in this downtrend. Question is what happens when we hit 4,300? Are we going to be hitting a stopping point? Is that the ground, or will we break through? And I think that there's going to be a headline, and it looks like if you look at when we get into this like moment of pressure where either we're going to bust up or we're going to bust down, and that looks like around March 7th to March 14th. That just happens to be the time when the Fed is meeting, right? So all eyes are on the Fed. Wall Street's already digested a quarter point hike as well as a whole bunch of quantitative easing coming to either slowing down or even coming to a stop. I don't think that we're going to start seeing that quantitative easing selling at this time, but we're definitely going to see it either slow down or stop. Remember, the Fed is purchasing a whole bunch of mortgage-backed securities and Treasury securities to this day. So they're talking about turning off the valve. The question is in the Fed writing, and remember, everybody dissects what the Fed says. They parse through the Fed statements word by word. They said that they would do a measured response. And so the question is inflation big enough that the Fed won't do a quarter point like Wall Street's already digested, but do a half point move?
Yeah, that'll be the big news, and the chart is definitely setting up for something to take
Something's going to
effect.
happen. For you advanced option traders out there, you should be thinking about possible straddles and strangles in this situation, right? That's where you make money, whether the underlying symbol goes up or down. We just know that it's not going to stay going sideways. So that's a little strategy there. But I got to give you my 2 cents. My 2 cents is I still watched, like I talked about last week, the Treasury, the bond purchases. And a lot of equity traders don't pay attention to anything but equities. But I keep my eyes on everything from foreign exchange currencies to the cryptos to the commodities like gold, silver, oil, copper. And I pay attention to bond purchases. And I look especially at the 10-year Treasury bond yield. And if the long-term inflation was really going to be something on investors' minds, that number would be going up, and it isn't. And so what that tells me is investors still strongly believe that this inflation is going to moderate. I think that ties back to what we're seeing here, where economies are opening up, people are rejecting staying inside where they want to go back to normal. And when things go back to normal, what's going to happen? We're going to start seeing local entertainment, local restaurants, all the local stuff is going to start opening back up. People are going to feel comfortable about going back out and spending their money there instead of sitting at home buying things off of the web, off of Amazon, off of things like that. And that's going to naturally, when you reduce the demand on the supply chain, that's going to moderate the supply chain back up. And so probably, and I'm guessing by April or May, we're going to start seeing inflation going back down, prices at pump going down, and hopefully by then, whatever uncertainty is associated with, Russia on the border of Ukraine, that moderates too. Because from what I understand, again, I'm no expert on any geopolitical things, but it's going to get muddy, and they're not going to be able to drive their frickin' tanks, right? So they either
Yeah.
have to do it now or do it next year, because it's not going to happen in the spring.
Yeah, and I feel like with in the 2.5 years since the pandemic, we're now closest to being over it than ever. Primarily, I think this week it was the Super Bowl. There was all this chatter about all these celebrities, all these fans not wearing masks at the Super Bowl, and then there's still all these policies in place. So different regions are starting to roll back at least the indoor mandates, which is definitely a big change from the narrative the last, at least before this last Omicron wave and whatnot.
Right? Gavin, your guys there in California, that was one of the most strictest, and I think Gavin dropped a whole bunch of your regulations coming up soon.
Yeah, and
Even
for here, it's the battle between the state and the county, and there's
yeah.
25 million people or whatnot in LA County. So,
I mean,
but
same
that's
here. Washington D.C. was one of the strictest, and they've already made announcements that they're opening up, I think March 1st or something around there.
So even in theory, the next 2 or 3 weeks could really start to get us back to normality, and that should help gauge what real inflation might be versus, something
Yeah.
that's kind of been clogged up for 2+ years.
And like we were talking about last week, you notice that a lot of companies are capitalizing on the snowballing of this, hysteria around inflation, and they're using it as an opportunity to raise prices. I mean, Netflix, they don't have anything to do with the supply chain worries, but they announced a price increase. And if you look at their, earnings report from this last season, all these companies are flush with money. So they've been making money hand over fist, kind of riding this ball, saying, well, there's got to be inflation. So this makes it a great opportunity for us to raise some prices, which is good for us investors, maybe not good for those folks on Main Street.
Totally. So we'll keep an eye on that the next couple of weeks. We'll go ahead.
I got to mention Roku. Roku missed earnings and Roku got hammered. And what I think we're going to see in 2022, very similar to what I saw back in 2001 when I was still living in California, living through working at Hewlett Packard. I think a lot of the tech companies that have been funded by a lot of VC money and then have gone public, and we talked, I don't know, maybe about 5 or 6 shows ago with these SPACs. I think that you're going to see in 2022 a lot of tech companies that haven't been able to figure out how to make a profit, how they're just there. They're going to start dissolving. I think that's something I'm going to say that now, and we'll check on it throughout the year. But I think a lot of these companies that are just companies and they don't actually have a purpose, they're going to start disappearing.
Yeah, and Roku dropped 20% off of the earnings, and they're having some supply issues, but I think mostly because they are a hybrid of hardware and software. So we'll
Keep
see.
your eye on Microsoft too. We talked about Microsoft doing one of the biggest acquisitions of Activision. Everybody thinks that's a video game play, because Microsoft has the Xbox and all of that good stuff. I think it's a little bit deeper. I think they're thinking more long term. I think they're actually, what's his name? Mark Zuckerberg with Facebook spent a fortune changing the name of the Facebook mother company from Facebook to Meta. And he's all focused on what's called the meta universe, where you put on your goggles and you meet with people and you do everything in the meta universe. I think Microsoft's about to kick his ass in the meta universe, right? They've already got teams and they're making sure that their software, I mean, everybody thinks of Microsoft, they think of Windows 11, but Microsoft spent a whole bunch of time really getting into the cloud services with their Azure product and things like that. And this Activision, the fastest way you're going to get people comfortable with going into the meta universe is through the gamers. And I actually think this is a meta universe play. And Microsoft is positioning themselves to take a whole bunch of market share from Facebook because they're not going with the hardware approach. Facebook saying, well, we've got the headset. Yeah, who cares? You can anybody can copycat that headset. Go have it manufactured in China, and everybody will have the headset. You're nothing special. I think Microsoft is getting the intellectual property to really be the backbone of the meta universe, and we should watch that space.
Totally. Personally, I've done some virtual real estate investing. So maybe in a
Mm,
future episode, we could discuss it. It is a little bit more on the risque side, but if that's the future, now is the time to start to explore it. And I have, and I see a lot of promise too. So we'll keep that in the loop.
very
Um,
good.
Moving forward, let's go ahead and talk about a stock ticker that we've looked at in the past, and I believe we have some updates from your end on Goodyear Tire.
So we looked at Goodyear Tire a couple of weeks ago, and Goodyear Tire was one that we wanted to sell some premium on. And we've been talking a lot about what do we do if earnings is approaching. And so I wanted to explain that a little bit because a lot of questions came up because Goodyear Tire had their earnings. They had a earnings. Earnings is usually either reported before the market opens or after the market closes. Goodyear reported before market opens. They missed targets. Price of Goodyear dropped, as you can see here, fairly significantly. And what would happen if you are in your premium trade? And this actually answers the bigger question about why the heck do we do this, right? Why? Somebody asked me, a lot of people ask me, why don't you just buy and sell? If you've got something moving horizontal like this, why wouldn't you just buy on the lows, sell on the highs, and then even go the next level and short on the highs? And then buy to close on the lows. Why are you doing all this option stuff of selling premium and buying protection and waiting till expiration and all of that good stuff? And this answers that question, right? Well, first of all, when earnings is approaching, if you're just in a stock symbol or in some sort of leveraged option, we've talked about this in the past, Sip. One of the best things you can do if you're uncertain about what the earnings is going to do is simply cash out. Simply cash out of the position, see what happens. If nothing happens, earnings is a nothing burger, then go ahead and buy right back in after earnings, after the dust settles from earnings, and you're fine. If it does move, just wipe your brow and say thank you for being smart enough to cash out because you didn't wind up any sort of uncertainty. But even better is when we use our strategy. When we sell premium and buy protection, we create a trade zone. And when we create that trade zone, these boundaries are passive and they create a sort of certainty, not a sort of certainty. They do create certainty around what your max profit and min profit are going to be. You know exactly, and it's not like a stop loss order. We usually, when we're in a stock, folks think that their risk is protected based on a stop loss order. Well, those of us who are actual active traders know that stop loss orders, when you say, for instance, set a stop loss order at $18, And that $18 it's not the price that you're going to get stopped out at. It's the price in which the stop loss order is going to become active. And so if the price of the stock is moving very quickly, like it's dropping like a rock, you might trigger the stop loss order at $18. And if it's a market order, it might fill at $17.75. I've seen them fill as low as, like $1 below where the stop loss is. So, stop loss orders are what we call an active risk, abatement strategy. Whereas when we set up these trade zones, they're completely passive. And so if instead of liquidating your position, you set up your trade zone and the underlying symbol fell through that lower threshold, the beautiful part is passively, without you even being active, you can go ahead and understand that this protective put is going to offset any losses of your underlying symbol dollar for dollar, such that when you look at those two trades together, the risk stops at this threshold. There's no more risk, and you get to stay in the positions and handle them when the dust settles. And that's why a lot of people prefer this to just buying and selling, because in my humble opinion, unless you're an active trader and you do this to get your jollies, if what you're trying to do is set up some sort of passive income with active investments, this is the easiest way, by setting up these option strategies, that you can walk away from your trading platform. And if anything uncertain happens, it's dealt with passively. You don't have to be there right at the moment. You don't have to be attached to your trading platform on your phone. And while you're at lunch with your favorite friend, say, "Excuse me, I have to do this," and like leave them hanging, talking about whatever gossip that makes life, right? This is the best way if you're looking to make just higher returns with lower risk, which puts you into the world of active investing, to still have that semblance of being able to walk away from it and not have it go kaplooey, not having to babysit it. A lot of the people who ask me, would it be better, instead of doing options trading and all these strategies you're talking about, would it be better to just buy and sell? Yeah, if you don't mind being, pinned to a computer screen. The last time I was employed with a job, which I think is an acronym for just over broke, was in 2005. And the last thing I want to do is replace that 9 to 5 job with a 9 to 5 job where I have to sit at home staring at these screens. So the option strategy allows you to set these things and then forget. You come back at your own leisure and they deal with themselves passively. I hope that makes sense.
I've always appreciated that about your strategy, this strategy, the ability to disconnect from the screens, because as a trader myself, every now and then, back in the day, it used to be a lot more serious in front of the screens. And I tell you what, you can really go through some mood swings like that, and it doesn't, it can, upset you, it could hurt your health. So having this kind of passive strategy is definitely the best way to go about it, from what I've
Absolutely.
seen. Um,
Absolutely.
with that being said, let's go ahead and invite everyone to your daily workshop. So AJ has a daily workshop where, if you're interested in learning more about these strategies, you can, see examples, really dig into detail. And we've got a little clip here that we're going to play to invite everyone.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
Hey.
Nay.
So
Love
we
that
put
commercial.
we put the strategies in play, and then we go and let our robot car drive us around hands free.
That's the whole purpose. That was the whole idea behind that commercial, was, the metaphor between the Tesla Model S driving itself away and the way that you can automate your trading, both with passive strategies and with active automation.
And I feel like that's a good transition into some of our
Lightning round.
lightning round, some of our ticker questions.
Yeah.
The first one here, I believe, is from Richard, um, and he's asking about Ford. And Ford is actually in the news today, specifically because their competitive their competitive products, are considering offsetting and spinning off into their own businesses. Which, when I mentioned to you, you said that was a great idea.
I think that's a great idea. I mean, you're seeing that across the board. You're seeing that with companies like General Electric. At you see ebbs and flows. So at some point, they like to go ahead and bring as much under their umbrella as they can. And then you see periods of times where, like, let's roll out these successful components of our company into their own businesses. I mean, Ford uh, still dominates when it comes to pickup trucks, and now they've created this electric pickup truck that's going to kick butt. They've also got the Mach-E, the electric Mustang. So it just makes sense for them to roll that company off so that they can better compete on the same standing as like a Tesla.
Yeah, and they did invent the car, right? So that helps. And it might be safe to assume that we could get the same type of movement from whatever this new spinoff is, comparable to what Tesla's done over the past, few years, because it is kind of this revolutionary product, and we're
Yeah.
gonna be seeing more and more. I don't know if you saw the commercial on the Super Bowl, but I loved their commercial for the pickup truck.
All I know is I put in my $500 to get one.
Oh, so it's on hold.
It's on hold. Yeah.
All right. Well, let's dig into what we're seeing in the price action.
So this is for Richard in Evanston, Illinois. So the scoop is, if Ford rolls off their EV component, I think that's going to give Ford stock some stability, won't it? Because Ford overall is a fairly boring stock. And that's why I've always liked it, right? Because with options trading strategies, you can take something that just moves sideways, gives you a nice dividend, and you can create an income out of it. You can every month, or if you're using weekly options. But the thing about Ford is it's not quite on a um, oscillating schedule within its pattern. So here's what I would think about Ford. Let me see if I can move myself back into a. I don't want to show prices as a percentage. There we go. Back into the dollars. So Ford is something that I think I'd put in my holding for the long term. If I go back and I take a look, for instance, at a 2-year weekly chart, uh, Ford is doing well. Even if they roll off their EV, I think that it doesn't hurt to have Ford in your portfolio. And so one of the things I'm a big fan of the company. If you remember, they're the only one of the American car makers that also didn't take any bailout money back about 10 years ago, a little more than 10 years ago, when all the car companies were getting bailed out or bought out. Um, I would use a naked put or cash covered put strategy here, Richard. I would, in order to get Ford into my pocket, I would pick a price that I would be willing to pay for Ford shares either every month or even every week. In fact, let's take a look here. If I look at what you're seeing here for Ford is weekly options. So if I go out to February 25 and say I'm willing to pay $17 for Ford, remember, if you sell a cash covered put, what that means is, first of all, you're on the correct side of the equation for all this uncertainty, because if people are buying, you want to be selling. And so you sell this cash covered put. And remember, a cash covered put is a obligation by the seller to give $17 if the person who buys your put wants to exercise it. They're going to give you some stock. You're going to pay $17. So if you're willing to pay $17 for this stock, you can go ahead and sell this cash covered put. Make sure you have the $17 per share in your portfolio so that you could buy it. And then you sell this thing, and right now it's going for 16.5 cents. That means it's a dollar. Remember, options are sold in lots of 100. So this is $1.65, and this expires next week. So what does that mean? That means that if between now and next week this option doesn't get exercised, the price doesn't go below $17, then you get to keep that $1.65 per contract, and you get to do it again. So you just keep doing it, collecting this premium until you get filled at the $17 wish point. And if you don't get filled at the $17, then just every week you collect this premium money. And that's how a cash covered put works. You either lock in the price of the stock at the price you want to pay, or you make a little income. And I would do it on the weeklies, and I would pick a price, and I would reevaluate that price. For right now, I'd say $17. But if Ford starts to dip a little bit, make it 16. If it goes up a little bit, make it a little bit short, and make sure you're willing to pay that amount. Because ultimately, Ford will be in your portfolio for the long term. But in the meantime, let's collect a little premium. That's how I would do Ford.
Yeah, that's a strategy for a boring stock, and I would assume that you could apply that to a lot of boring stocks that you do see long term potential in.
Use that strategy if your ultimate goal is to have the stock in your portfolio for the long term. It's the acquiring of the stock. Don't have the need for instant gratification where you're like, I need Ford right now. Let's go out and buy it. Instead, turn it into a weekly income money making opportunity where you ultimately will buy Ford at the price you choose. Again, options trading is all about creating certainty, right? The scoop is people are always saying, aren't options risky? No, options are a way to create certainty in what you're doing in the market. If you know what you're doing, it creates certainty. I can lock in the price I want to pay, and if not, create a weekly income versus just going out and buying the security at its price and hoping that it goes up.
You're kind of just you're achieving the same goal, just using different tools.
You are exactly.
All right. Well, let's dig into another boring classic stock. And next we're going to be looking at General Electric.
Yeah, I think we just mentioned GE. So GE used to be it still is one of my favorites, but they did something a few months ago. They did a reverse split, meaning they were trading around anywhere from about $7 up to $12, and they did a reverse split because they wanted people to look at their stock price and derive value out of it, think that it was a little bit better than it was. So they did a reverse split, which drove the price up. So now it's trading up around $95 because options are sold in lots of 100. This puts it out of the price range for some of my traders. So some of my traders are only dealing with $5,000 or $10,000 portfolios, and so that makes the GE option trades a little bit hard to justify because it's an expensive stock now. It's up trading around $100. However, the pattern and the liquidity is to die for. You could create an income off this. If you have a $100,000 portfolio, this is one of the symbols I would have in my portfolio because this will create for you a monthly income in addition to the dividend that owning the stock has, that just won't stop. I've been trading GE for almost a decade with my exact option trading strategies. In fact, if I go back and look at 2 years worth of data, you can see that GE is one of the most boring stocks out there, which makes it delicious for generating income by selling options premium. In fact, that workshop that we did the Tesla commercial for, I'll show you in that workshop exactly how to do that. That workshop doesn't cost anything. Just sign up and sit in. It's just an ongoing webinar. Sit in on that workshop and you'll see. You could just set up an automatic ATM machine off of the GE symbol.
So, do we have a question from Buddy, or just the overall strategy?
Yeah, Buddy was saying, "What can I do with GE?" And my answer to Buddy is, if you've got a bigger portfolio, definitely more around the 50 to 100 or higher, 100K portfolio, you could set up the strategy here. It looks like, let's zoom in for specifically what we would do in the next days. Um, GE is coming off of a high, so I would either short some GE stock, or I would find a back month put option, which GE has a bunch of them and there's a lot of liquidity on it. I'd probably go out to January 2023 with my expiration date, and then go deep enough in the money that it's trading at parity and buy that put option. And then I would just let it ride until it bottoms out. It looks like it's going to bottom out probably between 87.50 and 90 if any history, plays through. Once it bottoms out and starts heading up, I'd set up that passive trade zone, and then I'd forget about it. I would totally forget about it until either the expiration date is gone, or yeah, till it makes sense to revisit it. Once you've got that trade zone, the trade takes care of itself.
Yeah, and GE is one of these legacy companies that hopefully can start to innovate some products and, work into this new super techie friendly world. All
Yeah.
right, moving on. Our next question is related to a ticker that we've looked at in the past, and this one comes from Katie, and Katie from, I don't know, I think
Austin,
agent
Texas.
Katie from Austin, Texas. Great place for steak. So we're gonna dig into Ruth's Steakhouse.
So we've been looking at Ruths. We actually shorted some Ruth symbol. And since we've revisited, we also set up our trade zone. So we shorted some Ruth symbols when it was up at its high. In fact, let me show you that in yellow because it's easier to see. And once it had bottomed out, just like we were talking about with GE, we went ahead and sold some near term at the money put options. And we went ahead and protected ourselves. This is actually Goodyear Tire in reverse. So the scoop here is, if you set up your trade zone, it doesn't matter that the underlying symbol went outside of the trade zone. The trade is protected. The risk stopped at that trade zone. Now, one of the other strategies you can employ, and I actually suggest people look at it, is, when we short the symbol, we do set up a stop loss order where if this symbol were to have gone against us before we had a chance to set up our trade zone, we would have gone ahead and bought to close and, taken the knocks on our head. Once we set up the trade zone, you can or don't have to do away with that stop loss order. If you do away with it, fine. It handles itself. But if you leave that stop loss order in place, what's nice is, while the risk stops here, interestingly enough, the risk also stops here. And now you're left with a protective option that is not offsetting the back month, or in this case, the shorted stock. Instead, that protective option is gaining unfettered, right? And so this gives you a neat opportunity. Now, I have to give everybody a warning. If you get stopped out of your covering position, you need to set up some sort of notification. When I get a notification from my broker that a stop loss has triggered and been filled, I get my broker's software to ding me both on my computer and on my mobile device. I get them to send me SMS text messages and emails, even though the emails get caught up in spam filters. I would never trust email to get me a notification, but I have them send me emails as well, so that you can come in before the end of the day and buy back that premium trade. Because if you get stopped out of that covering position, you're now uncovered or naked. And so you should, just to do your due diligence, you should go ahead and buy to close. And it'll probably, if you're breaking out of your trade zone, it's probably only worth like a nickel or even less than a nickel. And a lot of brokers, my broker will let me close a position if the underlying, if the premium position is less than a dime. they won't charge me commissions. So it's just your due diligence to make sure that you unwind all the parts of the positions before the settlement. And even if you don't, even if, like, I don't know, you're up on a trapeze or down underwater scuba diving and you just can't do it, it shouldn't be that big a deal because you cashed out and you have enough cash to cover this position. But a lot of brokers, I'll just give you a warning, a lot of brokers might give you a little bit of static. They might send you some warnings, send you some emails. Some brokers might go as far as to suspend your trading activities if you don't unwind and you go naked inadvertently. They'll think that you're a risky trader and they'll kind of slow you down. In my opinion, that means go find another broker, but it makes sense. And so do your due diligence. If you take on this additional kind of strategy where you're going to let your protective option go unfettered because you get stopped out of the covering position, make sure you unwind the premium position as well.
Wonderful. And with our last question of the lightning round, we're going to be looking at an ETF. And this is one that I don't think we've covered on any of the shows.
So this is coming from Davey. Davey sent me a message from Ottawa, Ontario, and he's interested in the XLF. Now, this is an ETF that monitors the financial sector, banks and brokerages overall, like how the companies that are banks and brokerages are doing. And I love it. I love this pattern. Let's go back. This is a 6-month chart. I'm going to go back 2 years. And so you can see here, I guess I've been looking at this maybe about a year ago. So I'm going to remove some of the drawings on my chart here. And we can definitely see, and I have to advertise one more time, you can see where potentially there was a change in personality. We had this uptrending symbol over here, and then it flattened out a little bit right about here. And what we're going to be doing on Tuesday for all people who are part of my premium selling program is on Tuesday, I'm going to give a lecture series. I'm going to give you a tool as well as a philosophy in order to find out the exact date and time that the underlying symbols decide to change their personality from one type of trend to another. And that's going to be really handy. So if you're at all on the fence of joining my program, you should definitely do that just for this Tuesday. But in the meantime, this stock has become somewhat boring. I mean, ever since about June 1st of 2021, it's gone from about $36 up to $40. It's had a $4 appreciation, a little bit less than 8 or 9% of its price, which means it's a fairly slow appreciating symbol. And I think that is basically representative of what's going on with banking in general. This is perfect for selling premium on. In fact, what I would want to do is I would want to buy some of this ETF or buy some of the option. Let's see what the liquidity is. For this particular case, I'd stick with the monthly options. I probably wouldn't be as interested in the weekly options. I'm going to get rid of looking at the weekly options just to clear up my screen. Yeah, as I would have suspected, this ETF's option chain is heavily traded, both on the call and the put side. So I wouldn't even worry one moment about being, the only guy. Look at this. You've got literally tens of thousands of contracts being traded, even deep in the money. So I would find myself a back month call option. Again, I'd probably go out to January 2023 or even January 2024 and buy some deep in the money call options that will be moving pretty much dollar for dollar with this ETF. And that would be on a low. So when it finds a bottom, probably around $38, I would go ahead and purchase those calls. And then whenever it hits a high, I would sell premium and buy protection, set up that passive trade zone, and then go on and just let that money accrue in my account on every expiration day. Like today, today's February expiration, you could start this March expiration, April expiration, do about 1 transaction, 2 transactions a month, and just create this ATM machine that starts, putting investment income into your account. I like that one. I like that one. That was Davey from Ottawa. I like what you're looking at, Davey. Thanks for turning me on to that.
Yeah, thanks, Davey. Thanks, Katie. Thanks, Buddy. Thanks, Richard. As always, if anyone watching has a ticker or a setup that they're looking at, feel free to drop it in the comments. Leave us a message. AJ will certainly take a look, see if it can, we can go over it. While you're doing that, feel free to hit that subscribe and follow button. We do like to provide you with as much relevant content as we can. Hopefully, you're taking a look at some of these and following along, learning.
Sip, did you go to the Super Bowl?
I did not go to the Super Bowl.
Okay, because last week we were talking about perhaps you dropping in and doing some tailgating or something like that.
You know what? I thought about it, but from what I saw, it was super closed off, right? Like there's all these
Mm.
fences and police, and I was just like, that's too much for me.
Oh.
But Wednesday, I did stop by the rally that was only like 3 miles from me. So that was kind of cool to, when the players get drunk and they mumble on the microphone with the trophy. I figured it would be worth, a little afternoon stroll to check it out. It is history in the making.
Yeah, absolutely, absolutely. That was I watched the game. In fact, my little one stayed up with me, and we watched the halftime show. I'm very much interested in the halftime show. That was a nice little. I've always been a good fan of Dr. Dre, and I felt bad when he had that stroke, so I was glad to see him out there performing. And of course, Snoop Dogg doesn't age.
No, it was a wonderful performance.
Yeah,
And
and it was
yeah,
cool seeing the game, man. The LA Rams kicked
you know
ass.
what? Always they don't get paid for that performance. Did you know
No.
that?
Yeah, in fact, I think wasn't it Jay-Z? I saw him, they put the camera on him. Wasn't he the one who even produced it? He paid for all of it?
I think Dre paid for his portion, is what I heard,
Ah,
but Jay-Z seems like the kind that's like, hey, if you don't pay me, I'm already
yeah.
doing all right.
Yeah. Yeah, I know, but it sure is a lot of, cred, for anybody who but, none of those people are trying to push an album. Those people are all established.
Yeah, well, Snoop Dogg's kind of this entrepreneur these days, which is
He
very
eh,
interesting to see.
him and Martha Stewart.
Yeah, well, he bought his old record label. I don't know. He bought Death Row Records from
Oh,
one of
did he?
these VCs, and then the news was he's going to release NFT music through that label.
Oh, he's
Something like
taking
that.
advantage of the blockchain.
Snoop Dogg, he's I'm a big fan of his music
He's
and just in
he's
general.
got well, and he's got some really good advisors. He's surrounded himself ever since even coming onto the music scene, surrounding himself with Dre, who was an amazing producer at the time, and then just getting into the business world like that. He's smart and he's pickled. He's like Keith Richards. He's pickled for life.
Yeah, and I follow him on Instagram, and he does a lot of good content, not even just his own content. Um, all right, so we got one last question here. We can just throw out here.
Okay.
From Luther, he's basically asking thoughts on BA.
Okay.
Is it similar to GE? Is the
BA
question.
is Boeing. Let's bring our cursor over here. BA is very expensive. Let's go ahead out to a bigger. So Boeing trading at about $200. So remember, options are in lots of 100. And people always ask me, what sort of position sizing, and they always think it can be a very simple answer, like, should I put 10% of my portfolio in any one trade? Here's the key. The key is to understand, like, I like to simulate or run scenarios. I've created all sorts of tools that help me run scenarios about how the worst case trade could go, because that's going to help you understand risk. And once you understand the risk of the trade, and you know how much of your portfolio you ever want to put under risk, you can do so. Say, for instance, the trade is coming up with, if it goes completely against you, you're going to lose 10% of your invested dollar. And you say to yourself, well, I only want to open up my portfolio to a 2% loss. That means, if the trade's going to have 10% and you want your portfolio to be limited to a 2% loss, you can only trade 1/5 of your portfolio. It's algebra, right? So keep that in mind, because then if you say, okay, I can trade 1/5 of this, and the price of this thing is $200 times 100 shares per option contract, so $20,000. Do you have $100,000 portfolio? So that's something you have to think about when you start dealing with these high prices. But the pattern is absolutely like GE. It's delicious. It's slightly trending down, which tells me that I'd want to get in on the top side of this with the premium trading, which means right now is good. I'm going to zoom back into a more current looking chart. We're forming a top. So that means, we've used these terms before. Range expansion will always, since we've got an overall downtrend, range expansion of this trend is always when the underlying symbol goes down. And range contraction is when it goes against here, against the overall long-term trend. So we just got out of a range contraction phase. We're thinking about range expansion, and this is the perfect time. Either you're going to be shorting some Boeing symbol, or you're going to be buying some deep in the money, far out in time puts that are going to be moving with Boeing dollar for dollar, only inverse. In other words, when Boeing drops a dollar, those deep in the money, far out in time puts will go up a dollar. And then you're going to wait patiently. And once they approach this, it looks like $180 frame, and they turn themselves around and start in another range contraction phase, that's when you're going to set up what we've been talking about this whole show, the passive trade zone. You're going to sell some put premium, buy a protective call. The strike prices of those two options that you're going to do are going to set up a trade zone. So your protective call would have a strike price up here, somewhere around 215, 220. Your sold premium will be down here. This would be a put. You would sell a near term 180, 185. You'd go 3 to 6 months out over here on the protective call. And now you've got this trade zone, and you've got certainty of what would happen if the underlying symbol goes above or below, in or out of your trade zone. If it stays in the trade zone, everything expires worthless, and you just do it month in and month out. You create that income. If it goes out, you know exactly what these numbers are going to be. It happens passively. You don't have to pay attention to anything. So Boeing, just like GE, you need to have a big portfolio, but if you do have that big portfolio, this is money.
Lovely setup.
Yeah,
Thank
good
you
one,
for that.
Luther.
Thank you for that, Luther. As always, feel free to drop any questions, comments in the chat. We'll get back to it. And with that, anything planned for the weekend, AJ?
We're getting ready. In fact, next week's show, you're going to have a different backdrop, because we're going to be transferring, my wife and I and my little one and my cat. We're going to be going to our beach house. So we're going to be at our beach house for about 10 days on the South Carolina coast, rather than up here in Washington, D.C. A lot of people are saying, well, what? I thought you were in Colorado. The company, Trading Trainers in Colorado, and they're still working. In fact, they do better when I'm not there. They run the education company and make sure everything stays legit very well. And when I'm there, I tend to slow things down, because I tend to be a distraction. So I stay here in my home. Sometimes I visit them, but they're always like, go home, go home. So I'm here in Washington, D.C., or down in South Carolina, or on the road somewhere. So we're going to be heading down. So I guess this weekend is all about packing. I found that now that I've got a little one, everything takes a lot longer.
Yeah, and she's growing some hair these days. I saw some pretty funny photos you posted up with the Yeah.
Yeah, she's our model. She's also done this thing where she likes to now roll on her tummy and go under furniture, and so it's
Oh.
constantly a battle of and like I'll reset her, I'll put her on her back, and so it's now like this competition. She's like, I'm gonna
Mm.
try again, and she tries to like race me under the furniture, which is great because I'm not the best one at dusting under the furniture.
Yeah, there you go. Put it there's an effective use to the belly, crawling all around the space.
Yeah.
Awesome, AJ. Cool. So another solid episode. Appreciate everybody tuning in. Drop your comments, and next week we'll have some more stuff for you.
My parting comments are, guys, watch this. It's either the 50-day moving average or the 10-week moving average. If you're looking at a weekly chart, um, I just want to show one more chart, and then we'll end. I sorry, Sip. I know you got, but take a look. If I switch over to a weekly chart, and you can do this on your symbols. I'm looking at the S&P 500, but I want you to watch this carefully, folks, because if we are on a weekly chart and we put our 10-week simple moving average, which is the same thing as the 50, a lot of long-term investors look at this as a sell signal. So if you're long, for you long-term stockholders, and you notice that your stock symbol is wrestling with the 10-week simple moving average, you know, you may want to hedge that, or you may want to think about selling. Again, I invite you to come to my workshop so you can see how to be more of an active investor, but still with passive strategies. I think selling premium is that place where you can, take the plunge and get into selling that premium and setting up those passive strategies that you don't need to be day trading or actively trading. But I'm just giving you a little warning. There's being a challenge here to that 10-week simple moving average, and that is a sell signal for a lot of people.
Definitely. So we'll keep an eye on that. And
That's all I
uh,
got.
with that, everyone, we'll catch you next week.
Take care, guys.
Adios.
Adios, everybody.